Hi honeys, it's Phoebe here, and I had a question in the Facebook group about how do I invest in shares. So I just wanted to go through a couple of ways that you can invest in shares. First, let me start with a disclaimer. This is general advice only and not meant for you specifically. So what I mean by that is we're giving you factual and educational information and not advice that's particular to your own financial circumstance. When you want that kind of advice, you really need to seek the opinion and expertise of an expert. But we'll go through that in a minute. First, let's talk about shares. So you can invest in shares directly or indirectly. Now, direct investment in shares is going to a share broker or going onto one of the share apps like NAB Trade or ComSec. There's quite a few of them out there. I'm sure you know ANZ Trade. Most of the banks have them. There's a few off-bank ones. For each transaction, you'll pay a fee and you can invest directly in a company of your choosing. So if you wanted to buy Wesfarmers shares, for example, because you're a big Kmart fan, you can go on directly and buy Wesfarmers shares. You can choose how many you buy, and those shares will then come into your share portfolio and pay you a dividend, which might be small or might be large. You can find all the information out about what dividends have been paid in the past and how the shares value's been tracking against other shares on the ASX website. There's quite a lot of information there, and also on your own trading platform. So that information exists so that you can do research into the shares that you're buying when you're buying direct shares. If you go to a share broker, they'll charge you a fee, but they'll provide you that intelligence directly and very specifically to you. So it's up to you what you want to do with that. Indirect share investing is probably the most common way that people invest in shares, because when you have a super fund, your super fund is probably going to be managed by someone who is organising that direct investment into shares. So a fund manager will choose which shares they're going to buy and which shares they're going to sell within what we call a managed fund. As I said, could be part of your super, but you can also invest in managed funds outside your super. Most of them have a minimum investment limit. They also have, they have a minimum investment limit, but they also have fees and charges within, and they buy and sell within the fund. Second and more passive way of investing is through exchange traded funds. Now, exchange traded funds have become quite popular. They track against things. So they track against something like the ASX 200 or the ASX 100. You can get them in bundles that are in ethical investments, that are in environmentally friendly investments. There's such a wealth of exchange traded funds out there, but what they are is just passively. So where a managed fund has a managed fund manager who is constantly tracking against constantly looking into the shares and how they're invested, an exchange traded fund is tracking against an exchange like the Australian Stock Exchange and just buying and selling shares as they drop in and out of the top 200, for example. Now there's lots of different exchange traded funds, and a really good place to start investigating them is on the Australian Stock Exchange website. There's about a 15-minute course that you can do that just gets you to understand what that product's all about. And then the third way is through micro investments. Now you might have seen, I think Commonwealth Bank has one, there's Spaceship, there's Raise, all these very small investments that are looking for micro investments, and they all work differently. But the basic premise is that you either put a small amount in every month or you use a roundup. So for example, if you're spending $5.50 on a coffee, it rounds up to $6, and then that 50 cents gets invested into your micro investment app. These are quite a popular way to start. They generally come with quite a lot of information and let you know how your money's being invested, and you can choose to go very low risk to very high risk, and also environmental, crypto. There's a whole lot of different investments in those as well. They're generally better for investments under $5,000, where the exchange traded funds are generally better investments over $5,000. And that's general, it depends on the fees and charges of the actual fund. So those three ways, you can go direct and invest in shares, or you can go indirect through managed funds, exchange traded funds, or micro investments. Once you've decided on, when you're looking at all of that sort of stuff and you're looking at which one might be better, might not be better for you, think of these things. One is how much risk you are willing to take. Now, in our workbook, which we gave you part of the other day, we've got a risk profile questionnaire, which is just for you. It's the sort of thing that when you go and see a financial planner, they will give to you. And it just gives you an indication of what your appetite for risk is. So would you do a high risk for a high return? And by a high risk, we mean it's more than just not making any money. It might mean that you risk the amount of money that you put toward the investment. So for example, if you spent $10,000 in shares and then when you needed the money and went to sell it, those shares were only worth $5,000, you've lost $5,000 of your initial investment. That's called a capital loss, and you are at risk of a capital loss when you invest in shares, managed funds, exchange traded funds, and micro investment apps. So there's different risks for different returns. How much experience you've got can matter. So if you're an experienced investor compared to someone who's not so experienced, you might want to do a little bit more research and seek the opinions and advice of an expert. Also, cost. Now, there is a cost when you have a managed fund or shares or an exchange traded fund or a micro investment app. There are costs that go with that. There can be the cost of the fees on the fund, and there can also be tax implications for the money that you earn in the fund and for buying and selling those shares if you're buying them at a profit, or if you're selling them at a profit, you could have a capital gains or other events. Again, this isn't direct advice, so this is just giving you examples of what could happen, and it's general in nature. So I don't know your particular circumstances, and I really need to stress that. The other thing that you want to consider when you're investing is your time horizon. What is the possibility that you're going to need that money in the next month, year, 5 years, or 10 years? How long can you invest it for? And is investing directly in shares outside of your super fund more or less tax effective than investing through your super fund? A lot of super funds these days will allow direct investment. So that's something to consider as well. So that's my spiel on shares. I hope that's been helpful. You can get a bit more information about all of this particularly on the Australian Stock Exchange website. You can look through your own super fund. Your own super fund may provide you with a financial advisor. They may not, but there can be an advice line, particularly if your super fund allows you to do direct investment. Not all of them do. And you can also get more information by seeking the advice of an expert, such as your accountant or a financial planner. I hope that's been helpful. Please ask me anything. We're here to help in the Happy Honeys.